The global financial system is starting to shift, and capital is already moving. A $37 trillion reset is now being openly discussed at the state level, and whether it happens or not is no longer the key question. The key question is where capital moves if trust breaks, and right now, Bitcoin and gold are not reacting the same way. That divergence is the signal, and it is already happening. Welcome back to Bitcoin Capital Gold. A global financial shift is underway with Bitcoin and gold at the center. We track how institutional capital moves between them, understand that flow, and position with it. What the $37 trillion reset narrative is actually saying. A senior Russian advisor says the United States intends to push the global financial system into what he called a crypto cloud, using stablecoins and digital assets to absorb and effectively devalue America's $37 trillion national debt. The mechanism is not a default, it is inflation distributed globally through dollar-pegged digital instruments held by millions of people worldwide. The mechanism being described is not new. This is how sovereign debt has been managed throughout history. After World War II, during the 1970s, after the pandemic. Create more currency. Let inflation erode the real value of what is owed. The debt appears repaid in full, but the purchasing power of what is returned has been quietly diluted. The stablecoin version extends that same trick globally. Every holder of a dollar-pegged token absorbs the loss if the dollar is inflated, not the issuer. The U.S. exports its inflation digitally, at scale, to anyone with a smartphone. What this means for Bitcoin and gold investors is not the political narrative, it is the signal. When major governments frame the monetary system as a mechanism for debt devaluation at the state level, it tells you something important about trust. And trust is what moves capital. How capital behaves when trust starts to shift. Capital does not wait for certainty, it moves on probability, on the early perception that something is changing, and the signal that something is changing in the global monetary system is not subtle right now. It is visible in central bank balance sheets, it is visible in sovereign reserve allocations, it is visible in the price of gold, which crossed $5,300 and then made an all-time high at $5,627. Moves that do not happen in a stable, confident monetary environment. For the first time in approximately 30 years, gold has overtaken the US dollar as the world's largest global reserve asset. Central banks collectively hold gold valued at around $4 trillion, compared to roughly $3.9 trillion in US treasuries. That is not a coincidence. That is institutional capital at the sovereign level making a statement about where it believes long-term value is more reliably stored. China, India, Poland, and numerous other central banks have been systematically increasing their gold holdings. This is strategic reserve diversification, a deliberate reduction in dependence on dollar-denominated assets. These are not emotional moves, they are multi-year allocation decisions made by the most sophisticated institutional capital managers in the world. They are responding to exactly the kind of systemic pressure that the $37 trillion reset narrative describes. When capital moves under systemic pressure, it follows a sequence. It moves first toward what is most established, most trusted, and most liquid. It moves toward what carries no counterparty risk, assets whose value does not depend on any institution honoring a promise, and it moves away from anything that could be repriced, redefined, or restructured by a government decision. That sequence is the key to understanding why Bitcoin and gold are not reacting to this environment the same way. Bitcoin and gold are not in the same conversation right now. Capital is not choosing between them equally, it is sequencing between them. Gold understands this moment. It has been here before. It was the anchor of the global monetary system for centuries. When Nixon severed the dollar's link to gold in 1971, the most significant financial rule change of the modern era, gold did not disappear, it repriced. It went from $35 an ounce to over $800 within a decade as the market recalibrated what the dollar was actually worth without that backing. Gold knows what a monetary reset looks like because it has survived every version of one. Bitcoin is a different kind of asset in a reset scenario, and the difference is important. Bitcoin's supply is fixed at 21 million coins. It cannot be inflated, it cannot be printed, it has no counterparty risk, and it operates outside any single government's control. In the long run, those properties make it one of the most compelling monetary alternatives ever created. But Bitcoin is 15 years old, gold is thousands, and in a systemic stress environment, when institutions are making defensive allocation decisions, the asset with the longer track record of trust gets the first wave of capital. Right now, Bitcoin is still heavily influenced by liquidity conditions and risk sentiment. When risk appetite falls, Bitcoin tends to fall with it. When institutional investors face redemptions or need to reduce exposure quickly, Bitcoin is liquid enough to be sold fast, and it gets sold. That short-term behavior is real. It does not invalidate the long-term thesis, but it does mean that in the early stages of a reset-type scenario, when uncertainty is elevated and capital is moving defensively, Bitcoin is not the first destination, it is a later stage of the same journey. The divergence visible in the charts right now reflects exactly this. Gold is finding support, building a base, and responding to structural demand from central banks and institutional allocators who understand the monetary environment. Bitcoin is compressing, uncertain, waiting for a clearer signal. Both assets are in the same story, they're just at different points in it. What the stablecoin expansion tells us about gold demand. There's a specific reason why the stablecoin dimension of the reset narrative is causing gold demand to accelerate, and it comes down to trust, auditability, and historical precedent. Stablecoins are dollar-pegged digital tokens. Every USDT or USDC in circulation is supposed to be backed one-to-one by a real dollar or treasury equivalent. In theory, the system is transparent. In practice, you have to trust the issuer and their auditors, who are predominantly US-based. For a foreign government or sovereign fund making multi-trillion-dollar allocation decisions, that is not an acceptable level of trust. There's nothing technically preventing the rules from changing. The US has done that exactly before, in 1971 when the dollar's gold convertibility was simply ended. One decision, no warning. The promise was canceled. That historical memory is driving gold demand right now as much as any current data point. Foreign institutions are not moving into gold because they have done complex models. They are moving into gold because gold is the one asset that has never had its rules changed by a government decree. It cannot be inflated, it cannot be defaulted on, it cannot be redesigned. In a world where the monetary rules are visibly under discussion at the highest levels, where a senior state advisor is publicly framing the global financial system as a mechanism for debt devaluation at the state level, gold is the response that does not require trust. Where capital moves first and what comes after. The sequence under systemic monetary pressure is not complicated once you understand the logic. Capital moves away from anything that could be repriced by policy. It moves towards physical, finite, uncontrollable assets. Gold gets the first wave because it is the established institutional reserve asset, the one that central banks already hold, already understand, and already have the infrastructure to manage at scale. Bitcoin gets the second wave, not because it is less important, but because its institutional infrastructure is newer and its track record shorter. The arrival of regulated Bitcoin ETFs has begun closing that gap. Institutional investors can now access Bitcoin through familiar, regulated structures. Each year that Bitcoin survives a macro shock and recovers extends the track record that large-scale allocators need to see before committing meaningful capital. The 2019 precedent, where a Fed policy pause preceded a significant Bitcoin recovery, is not irrelevant. It is a data point in an accumulating case. What would shift the edge back toward Bitcoin in the near term? A genuine Federal Reserve pivot toward rate cuts combined with balance sheet expansion, the conditions that flood the system with liquidity and send risk assets higher. A stabilization of the geopolitical environment that reduces oil pressure and brings inflation expectations down. And a continued maturation of the institutional Bitcoin market that deepens the buyer base and reduces the short-term correlation with risk sentiment. None of those conditions are fully present right now, but they are not permanently absent either. This is not an ideology question, it is a sequencing question. The $37 trillion reset narrative, whatever its ultimate accuracy, is a symptom of something real. The global monetary system is under structural pressure. Debt levels are historically unprecedented. Policy options are constrained. Trust in dollar-denominated instruments is openly being questioned at the state level.
These are not temporary conditions. They are the environment in which capital allocation decisions are being made right now. In that environment, the question is not whether to hold gold or Bitcoin. The question is sequencing. Which asset captures the first wave of capital under systemic pressure, and which captures the second? The answer in the current environment is clear. Gold captures the first wave. It already is. The central bank data, the reserve asset crossover, the price performance through the geopolitical stress of early 2026, all of it points in the same direction. Bitcoin's moment in this story has not passed. It is approaching from a different angle and on a slightly longer timeline. The fixed supply, the institutional ETF infrastructure, the growing evidence of durability, all of it is building the case for Bitcoin's second wave positioning. But that wave does not arrive while liquidity is tight, oil is above $100, and institutional risk appetite is suppressed.
It arrives when those conditions change. The bottom line: a reset of the global monetary system, whether through crypto, stablecoins, inflation, or some combination of all three, is not a fringe idea. It is a description of what has been happening incrementally for decades, now potentially entering a new and more visible phase. The signal that this phase is intensifying is visible in gold demand, in central bank reserve allocations, and in the willingness of state-level actors to describe the monetary system as a battlefield in public. Capital is moving. It is moving toward assets that cannot be repriced by government decision. Gold is receiving that capital first, and the data on central bank accumulation, reserve asset crossovers, and price performance all confirm it. Bitcoin is in the same story, sequenced after gold, dependent on a liquidity environment that does not yet exist but is building toward it. The situation is not resolved, but capital is already making its move, and positioning with that development rather than reacting to it after the fact is what this channel is built to help you do. If you found this analysis useful, consider liking and subscribing so you don't miss our next video. Do you think capital is already moving from Bitcoin into gold, or are you positioned in both? Share your view in the comments below. At the heart of the new global financial economy will be Bitcoin and gold. If you want to be ahead of the curve, follow this channel.